Today, I'm going to give a jargon-free explanation of essential insurance products in Ireland.
Mortgage protection.
This is a life insurance policy that the bank will insist you take out when you are taking out a mortgage with them. It essentially is a life policy that you start at X amount to cover that will decrease over time as you clear down your mortgage. Ultimately, this is the bank protecting their interest in you. If you pop your clogs, they want to make sure they recoup their investment in you. If it's just mortgage protection, it is just clearing the mortgage and it's not necessarily taking care of you or your family.
Income protection.
Arguably one of the best products, if not the best product in the Irish marketplace. So income protection is a protection plan that allows you to protect your ability to earn an income. So if you think about it, your income allows you to pay your bills, live your life, go on holidays, meet up with your friends. If you don't have a safety net with work, in the sense of if you're out of work, sick, injured, incapacitated, most employers only have a statutory obligation to pay out for somewhere between 3 to 5 days. After that, it is the state disability on its own, if you're entitled to it. With income protection though, you can take out a protection plan that if you do get sick, injured, incapacitated, so I'm talking you put your back out lifting your child out of the bath. I'm talking you have whiplash from a car accident. You have a bad knee from hiking, playing sports. You're suffering, God forbid, with a cancer, heart attack, stroke, Alzheimer's. With income protection, you protect yourself for a maximum of 75% of your salary, less the state disability. And if you are unfortunate enough to get sick, injured or incapacitated, the plan will step in and provide you with an income until you either A, get better and return to work, B, turn 65, 66, whatever C age it is set, or C, unfortunately, you've passed away. This is the foundation of financial planning, making sure you protect your ability to earn an income.
Life insurance.
It is a policy on you, a protection policy on you, that if you die, the plan will pay out, and that money is used by your partner, your spouse, your kids to go towards the raising of them, essentially. So you think about it, if it's you and your partner, you've got X amount of an income coming in. If one of you drop out of the equation, that's a whole income dropped off. If you're not married, you're not entitled to the state widow's pension. So are you now raising a couple of kids on your own with no state support, i.e. the state widow's pension? And while you might have mortgage protection, say, to clear your mortgage, you can't eat bricks and mortar. And if we all look at the raising of family, it costs a lot. That's essentially what life insurance is.
Specified illness cover.
When we look at specified illness cover, we'll always kind of show you the list and the ailments that are covered. So you'll have your big players in there, your cancers, your heart attacks, your strokes, Alzheimer's, what have you. There's also things in there like blindness, loss of independence, i.e. you're a paraplegic or a quadriplegic, loss of speech. Some things in there that you wouldn't necessarily think happen on a day-to-day basis. But if you get diagnosed with one of these ailments, you are entitled to this tax-free lump sum to do it as you see fit.
Shareholder protection.
This is a protection plan that we predominantly see with business partners. So let's say we've got Jim and John who work in a construction company, or they set up a construction company themselves. The boys are working away, they're making good money on it. It's a 50-50 shareholding and they don't really think about anything other than the day-to-day run of the business. However, both of them have their own respective families, dependents and what have you. They may be the main earners, they may be the sole earners in their household. And there might be an unwritten agreement of, oh, okay, if anything happens to me, I want the wife and the kids to be taken care of. But it's generally an unwritten agreement. So it's one of these things that we kind of go, I'll take care of that in the future. Whereas a shareholder protection policy is effectively Jim and John take out life cover on each other. The business pays the premium for the plans. Let's say they decide the business is worth 2 million euro, okay? They insure each other for €1 million. The business pays the premiums. God forbid one of them die. The plan will pay out the €1 million to the business. But there's also another part of shareholder protection. It's called the shareholder agreement, in that the business is obliged to buy the shareholding of the deceased partner from the family, and the family can also trigger the business to buy their element of the shares to essentially take care of them. But this is ultimately, the business gets to stay with the business partner, but the family of the person who's passed away has been taken care of. Please look at shareholder protection as a beneficial way to protect the business and your family.